Most people assume that the biggest risk to their wealth is a stock market crash. Others worry about inflation. Some fear recession. But what if the greatest financial risk isn't any of those things? What if the real danger is a gradual loss of confidence in the monetary system itself? And what if one of the most misunderstood assets in the world could become increasingly important during that process? Today, we're going to examine a question that occasionally appears in precious metals circles and often sparks intense debate. Could silver ever experience a dramatic revaluation during a major monetary reset? Some analysts have suggested theoretical scenarios involving gains of hundreds, thousands, or even several thousand% relative to today's prices. Now, before anyone jumps to conclusions, this is not a prediction. No one knows exactly what silver will do. No one knows when the next financial crisis will arrive. And no one can accurately forecast future prices with certainty. But understanding why such ideas exist and what economic conditions would be required to make them possible can teach us something important about debt, currencies, precious metals, and wealth preservation. Because here's what's really happening behind the headlines. The world is carrying record levels of debt. Governments are running enormous deficits. Central banks are walking a tightrope between inflation and economic growth. Critical minerals are becoming increasingly strategic. And trust, the foundation of every monetary system, is being tested in ways many people don't fully appreciate. Most investors are looking in the wrong place. They're focused on daily market fluctuations while ignoring the structural forces developing beneath the surface. Few people understand the chain reaction that could unfold if those forces accelerate. In this video, we'll explore 6 critical insights. We'll examine where the 7,000% revaluation theory comes from. We'll look at the supply realities facing the silver market. We'll discuss the industrial demand revolution underway today. We'll explore historical periods when monetary systems experienced stress. We'll examine why institutions and governments are paying increasing attention to hard assets. And finally, we'll discuss what ordinary people should understand as they navigate an increasingly uncertain financial environment. Let's begin with what's really happening. The idea of a massive silver revaluation generally comes from one simple observation. Global debt has grown far faster than the supply of monetary metals. Over the past several decades, governments around the world have accumulated unprecedented liabilities. At the same time, central banks have repeatedly expanded money supplies in response to financial crises, recessions, and economic slowdowns. Here's what most people don't realize. Currencies are not wealth. Currencies are claims on wealth. The distinction matters. Let me explain this with a simple analogy. Imagine the global economy as a giant machine. The machine produces food, energy, technology, transportation, housing, and services. Money is the lubricant that allows the machine to operate efficiently. But if the amount of lubricant grows much faster than the machine itself, the value of each unit of lubricant eventually becomes diluted. This is one reason investors historically turn toward tangible assets during periods of monetary uncertainty. Gold and silver cannot be printed. They must be mined, refined, transported, and stored. That physical reality creates scarcity. The mainstream financial media often focuses exclusively on silver's price. What it frequently misses is silver's role as both a monetary asset and an industrial commodity. That combination makes silver unique. If you're interested in understanding the forces shaping precious metals and the global economy, consider subscribing. I post videos like this regularly. Now let's talk about supply. Imagine trying to fill a swimming pool while someone keeps turning off the hose. That's a useful way to think about the silver market. Mining is a long-cycle business. New discoveries are becoming more difficult. Permitting timelines are growing longer. Environmental requirements are becoming more complex. And many deposits contain lower ore grades than they did decades ago. Countries such as Mexico, Peru, China, Russia, Chile, and Australia remain essential to global mineral production. Yet the industry faces increasing challenges. Energy costs remain a major factor. Every ounce of silver requires drilling, blasting, hauling, processing, refining, and transportation. Each stage depends on affordable energy. At the same time, geopolitical tensions continue reshaping global supply chains. Export restrictions, trade disputes, labor shortages, and political uncertainty can all influence production. An additional challenge is that most silver isn't mined primarily for silver. It's produced as a byproduct of copper, lead, zinc, and gold mining. That means silver supply often depends on decisions driven by entirely different markets. Even if silver demand surges, producers cannot simply flip a switch and double output. The result is a market that can become surprisingly tight during periods of strong demand, and demand is exactly where things become especially interesting. Many people still think of silver primarily as coins, bars, and jewelry, but silver is increasingly becoming a strategic industrial metal. Its electrical conductivity is among the highest of any element. Its thermal properties are exceptional. Its versatility makes it essential in modern technology. Consider solar panels. Silver plays a crucial role in photovoltaic cells. As nations invest heavily in renewable energy infrastructure, silver demand continues expanding. Now add electric vehicles, add advanced electronics, add telecommunications, add military systems, add medical technologies, add artificial intelligence infrastructure. Every one of these sectors depends on highly efficient electrical systems, and silver remains deeply embedded in those systems. Think about the scale. Millions of solar panels, millions of electric vehicles, massive data centers, expanding electrical grids, advanced defense technologies. The quantities used in individual devices may appear small, but multiplied across global production, the impact becomes enormous. Silver is no longer simply a precious metal. It is increasingly becoming an industrial necessity. If this analysis is helping you connect the dots, subscribe and join our growing community here at Precious Metals Alert. History rarely repeats perfectly, but it often rhymes. The 1970s provide an important example. During that decade, inflation accelerated, energy prices surged, and confidence in monetary stability weakened. Precious metals responded dramatically. Then came the financial crisis of 2008. Investors suddenly questioned the stability of major institutions. Central banks responded with extraordinary monetary measures. Years later, the COVID disruption revealed just how fragile modern supply chains could become. Factories shut down, transportation networks slowed, commodity markets experienced major disruptions. Each event looked different on the surface, yet they shared a common theme. Periods of stress expose vulnerabilities that remain hidden during normal times. Markets often appear stable until confidence begins to change, and when confidence changes, price discovery can become extremely rapid. This is why long-term investors study historical cycles. Not because history repeats exactly, but because human behavior remains remarkably consistent. People tend to underestimate risk during calm periods and overestimate certainty when conditions become unstable. Understanding that pattern can be more valuable than any short-term forecast. This brings us to why smart money is paying attention. Central banks have been accumulating gold at historically significant levels in recent years. Why? Because gold remains one of the few financial assets without counterparty risk. It doesn't depend on someone else's promise to pay. At the same time, institutional investors, family offices, and sovereign wealth managers are increasingly examining resource scarcity, commodity security, and monetary stability. The global debt picture is impossible to ignore. Government deficits remain elevated, interest expenses are rising, demographic pressures continue building. Meanwhile, many nations are seeking greater economic independence. The BRICS nations have attracted significant attention because of their interest in reducing vulnerabilities within the existing financial architecture. This does not necessarily imply the end of the dollar, but it does suggest a growing desire for diversification. And diversification often leads investors toward hard assets. Organizations such as the IMF, World Bank, and major central banks continue monitoring debt sustainability, inflation trends, and financial stability risks. These issues matter because monetary systems ultimately depend on confidence. When confidence weakens, tangible assets frequently attract renewed attention. If you're finding value in these deeper macro insights, consider subscribing because we cover the stories mainstream media often overlooks. So, what should ordinary people do? First, avoid becoming trapped by extreme predictions. Whether someone predicts a collapse, a boom, or a 7,000% silver revaluation, remember that no one can predict the future with certainty. What people can do is understand probabilities. They can understand risk, and they can understand history. The goal is not to react emotionally. The goal is to prepare intelligently. That begins with protecting purchasing power. It involves diversification across different asset classes. It involves maintaining liquidity. It involves avoiding excessive debt. It involves thinking in decades rather than days. Most importantly, it involves recognizing that wealth preservation is different from speculation. Speculation focuses on price. Preservation focuses on resilience. Throughout 5,000 years of recorded history, three categories of assets have demonstrated extraordinary durability: gold, silver, and productive land. Empires disappeared, currencies failed, governments changed, financial systems evolved. Yet those assets continued to retain value because they provided something real. No one knows whether silver will rise modestly, significantly, or dramatically in the years ahead. But understanding the forces at work allows people to prepare rather than react, and that may be the most valuable lesson of all. As we conclude, let's step back and connect the dots. The discussion about a possible silver revaluation is really a discussion about something much larger: debt, monetary systems, resource scarcity, industrial demand, geopolitical competition, and wealth preservation. We've explored why some analysts discuss extreme revaluation scenarios. We've examined the supply constraints facing the mining industry. We've looked at the growing importance of silver in the modern economy. We've reviewed historical periods when confidence in financial systems was tested. And we've explored why institutions continue paying close attention to tangible assets. The future remains uncertain. It always has been. But uncertainty itself is often the reason people study precious metals, not because metals guarantee wealth, but because they represent an alternative form of financial resilience. Markets move in cycles, headlines come and go, but the laws of supply and demand never disappear. Neither does the importance of understanding history. Pay attention to the trends most people ignore, because sometimes the biggest opportunities emerge long before the crowd notices. If you found this analysis valuable, please like the video, subscribe to Precious Metals Alert, and share it with someone who wants to understand the changing world around us. Until next time, stay informed, stay prepared, and keep your eyes on the metals.